On the evening of August 15th, 1971, the fundamental anchor of the global economy was quietly severed. Without consulting the International Monetary Fund, the State Department, or international allies, a single televised address fundamentally altered the definition of money. The direct convertibility of the United States dollar to gold was suspended. This was not a mere policy adjustment or a temporary political maneuver. It was the demolition of a monetary foundation that had governed international trade for decades. The world went to sleep with a currency backed by a physical asset and woke up to a system governed entirely by sovereign decree. How did a measure designed to halt a run on American gold reserves permanently rewire the architecture of global finance? To comprehend the magnitude of this shift, one must understand the invisible tethers of the Bretton Woods system. Established in the waning days of the Second World War, this agreement pegged global currencies to the US dollar, which was, in turn, pegged to gold at $35 an ounce. The gold standard acted as a strict disciplinary mechanism. A nation could only print as much currency as it had gold in its vaults to back it. If a country ran a massive trade deficit, foreign nations could demand payment in physical gold, draining the debtor nation's reserves and forcing it to tighten its monetary belt. It was an automatic, impersonal check on government spending and the expansionary impulses of central banks. But the rigid discipline of physical bullion clashed violently with the political ambitions of the 1960s. The United States was simultaneously funding the escalating Vietnam War and financing expansive Great Society domestic programs. To pay for these massive initiatives without raising taxes to politically unsustainable levels, the government effectively printed more dollar than it had gold to support. The ratio of paper claims to physical metal grew dangerously skewed. Global allies, noticing the discrepancy, began to lose faith in the dollar's purchasing power. Nations like France started aggressively exchanging their surplus dollars for American gold, sending battleships across the Atlantic to physically transport the bullion back to European vaults. A classic bank run was unfolding on a sovereign scale. By the summer of 1971, American gold reserves had plummeted to dangerously low levels, threatening the nation's ability to meet its international obligations. The structural integrity of the Bretton Woods Agreement was collapsing under the weight of geopolitical spending and domestic fiscal expansion. Facing the imminent depletion of the nation's wealth, President Richard Nixon made the fateful decision to close the gold window. Officially termed a temporary suspension, the 1971 shock permanently severed the ancient link between physical scarcity and the money supply. The era of pure fiat currency had officially begun. Fiat currency derives its value not from a physical commodity, but entirely from government decree and the collective faith of its users. Stripped of the golden tether, central banks were suddenly unshackled. The strict limitation on money creation vanished overnight. A central bank could now expand the money supply simply through accounting entries, adjusting interest rates, and purchasing government debt to manage economic cycles. This newfound flexibility was hailed as a triumph of modern economic management, offering the tools to theoretically smooth out recessions and maintain high employment. Yet, this liberation carried a profound systemic vulnerability that would soon become apparent. The immediate aftermath of the decree provided a harsh lesson in the mechanics of unbacked money. Without the disciplinary anchor of gold, the 1970s witnessed a devastating surge in inflation. As the money supply expanded to accommodate government deficits and oil price shocks, the purchasing power of the dollar plummeted. Prices for everyday goods doubled, then tripled in a matter of years. The phenomenon of stagflation, a paralyzing combination of stagnant economic growth and runaway inflation, shattered the prevailing economic consensus. The invisible restraint of the gold standard had been replaced by the very visible reality of a currency losing its real value day by day. This crisis catalyzed a massive transfer of systemic power. Authority shifted away from the objective limitations of physical commodities and concentrated heavily in the hands of unelected central bankers. The Federal Reserve was no longer just managing a pegged currency, it was actively attempting to engineer the macroeconomic climate. To crush the inflationary spiral of the late 1970s, Federal Reserve Chairman Paul Volcker engineered a brutal tightening of the money supply, pushing interest rates to unprecedented double-digit levels. The medicine was severe, inducing a deep recession, but it successfully restored faith in the unbacked dollar. The event proved that a fiat system could survive, but only if the central bank maintained absolute credibility and was willing to inflict severe economic pain. Yet, surviving the immediate crisis masked a deeper, slower-moving mutation in the global financial architecture. The removal of the gold constraint quietly removed the natural ceiling on sovereign debt. Under the old regime, a government could not borrow indefinitely without eventually triggering a gold outflow and an ensuing credit contraction. In the new fiat paradigm, governments could issue debt continuously, knowing that their central banks could theoretically purchase that debt by creating new reserves. This dynamic fundamentally altered the relationship between the state and the economy, enabling an era of perpetual deficit spending that would span decades. As the money supply steadily expanded, a strange divergence emerged in the broader economy. Capital began to flow differently. Instead of primarily funding industrial expansion or infrastructure, a vast ocean of newly created liquidity found its way into financial assets. The financial sector, previously a utility for allocating capital to productive enterprises, ballooned into a dominant economic force itself. Commercial banks, hedge funds, and investment firms utilized the abundant, cheap credit to engineer complex financial instruments, creating layers of synthetic wealth that dwarfed the underlying real economy. The pursuit of yield in an environment of elastic money birthed an era of intense financialization. This elasticity fueled a new rhythm of extreme boom and bust cycles. The unmoored monetary system allowed credit bubbles to inflate to historically unprecedented proportions. When the cost of borrowing is artificially suppressed by central bank intervention rather than determined by market forces, capital is inevitably misallocated. The resulting speculative manias, from the dot-com frenzy at the turn of the millennium to the catastrophic housing bubble that triggered the 2008 financial crisis, were direct symptoms of a system lacking a hard constraint. Each crisis required even larger infusions of central bank liquidity to prevent systemic collapse, creating a compounding cycle of intervention. The response to the 2008 collapse represented the ultimate expression of the post-1971 paradigm. Central banks deployed a mechanism known as quantitative easing, purchasing trillions of dollars in government bonds and mortgage-backed securities to inject liquidity directly into the financial system. This was the fiat mechanism operating at its absolute theoretical limit. By aggressively expanding their balance sheets, central banks successfully prevented a global depression, but they also severely distorted the pricing of risk. Interest rates were pushed to near zero, and in some sovereign markets, into negative territory, penalizing savers and forcing investors further out on the risk spectrum to find returns. The echoes of that massive intervention cascaded through the socio-economic strata, generating profound secondary effects. Because newly created money enters the economy through the financial system, it disproportionately inflates the prices of financial assets like stocks, bonds, and real estate before it impacts consumer wages. This phenomenon, known as the Cantillon effect, ensures that those who already own assets see their net worth skyrocket. Meanwhile, those who rely solely on labor income find themselves struggling against the rising cost of living and housing. The systemic architecture of elastic money acts as an invisible regressive mechanism, quietly accelerating wealth inequality over decades. On the international stage, the abandonment of the gold standard paradoxically cemented American financial hegemony. Because global commodities, particularly oil through the petrodollar system, continued to be priced in dollars, international demand for the American currency remained insatiable. This dynamic allowed the United States to run massive, perpetual trade deficits without suffering the currency collapse that would destroy a developing nation. Foreign countries essentially export their manufactured goods to American shores in exchange for paper dollars, which they then reinvest into United States Treasury bonds, continuously funding American debt and reinforcing the dollar's dominance. However, this geopolitical advantage carries a latent fragility. A monetary system based entirely on trust and sovereign debt is highly sensitive to shifts in global power. When the United States leverages its control over the dollar network to enact international sanctions, freezing the foreign exchange reserves of adversarial nations, it sends a chilling signal to the rest of the world. Countries observing this weaponization of the fiat reserve currency are increasingly incentivized to seek alternative financial architectures. The slow, methodical accumulation of physical gold by foreign central banks in recent years suggests a quiet hedging against the vulnerabilities of a purely dollar-centric global order. We are left examining a profound paradox at the heart of modern finance. The architects of the fiat system promised that breaking the golden fetters would allow brilliant technocrats to tame the business cycle and ensure perpetual stability. Yet, the removal of the rigid, impersonal discipline of a commodity standard simply transferred the volatility from the currency to the broader financial system. Instead of sharp, localized banking panics, we now experience massive, systemic credit bubbles that require sovereign-level bailouts. The risk was not eliminated. It was simply socialized and shifted onto the balance sheet of the state. This socialization of risk is ultimately funded through the silent, compounding mechanism of inflation. When a government continuously expands its money supply to service unpayable debts or fund unfunded liabilities, it slowly siphons purchasing power away from every existing unit of currency. It functions as an invisible, unlegislated tax on savings. A dollar saved in the decades following the 1971 shock buys only a fraction of what it once did. The true cost of an elastic money supply is paid gradually by the public at the grocery store, the gas pump, and the housing market, eroding the foundation of middle-class wealth. To understand the full scope of this transformation, one must reconsider the fundamental nature of money itself. Historically, money emerged organically as a medium of exchange, a store of value, and a unit of account, anchored by something scarce and difficult to produce. It functioned as an objective ledger of human time and energy. The transition to a pure fiat standard altered that fundamental equation. Money became a political instrument, its value determined not by the energy required to extract it from the earth, but by the credibility of the institutions that issue it and the military power of the governments that enforce its use. This institutional credibility is now being tested by the sheer mathematics of the global debt supercycle. The total volume of sovereign, corporate, and household debt has grown exponentially faster than the underlying economic output required to service it. In a system where money is created through borrowing, debt must continually expand to prevent the money supply from contracting and triggering a deflationary collapse. We are locked into a perpetual growth machine that requires ever-increasing injections of liquidity just to maintain equilibrium. The system demands constant acceleration simply to avoid crashing under its own weight. Central banks find themselves trapped in a complex matrix of their own design. If they aggressively raise interest rates to combat the inflation generated by their own policies, they risk triggering a catastrophic wave of defaults across a highly over-leveraged global economy. If they lower rates and resume quantitative easing to support asset prices and government borrowing, they risk utterly destroying faith in the purchasing power of the currency. The policy tools that once seemed omnipotent are increasingly blunted by the sheer weight of accumulated systemic debt, leaving monetary authorities with no painless exit strategy. The decision made on that Sunday evening in 1971 was not merely an administrative adjustment to international exchange rates, it was the genesis of the modern financial world. By severing the link to gold, the global economy embarked on an unprecedented, decades-long experiment in unconstrained credit expansion. It unleashed immense financial innovation and facilitated explosive global trade. but it also engineered a deeply fragile architecture reliant on perpetual debt, institutional infallibility, and the continuous erosion of real value. The systemic impact of ending the gold standard continues to dictate the price of our assets, the power of our institutions, and the hidden forces that shape our economic reality today.